Hi candidate, welcome to another session of Manifested Online Classes. And I want us we continue with the topic of earnings per share. So this is our lesson number 3. In the previous lessons on the same topic, we defined what is earnings per share. We looked on the significance or basically the benefit of earnings per share. And also we were able to define some few terms. In lesson number 2, we defined what is basic earnings per share, and actually looked on how basic earnings per share is computed, and also we discussed on some of the reasons as to why the number of ordinary shares issued at the start of the year may change. So in this session, I want us to do an illustration question regarding the computation of basic earnings per share. And that illustration question is based on a past paper question, and the question is November 2019, which is question number 5A. So we go through the question and then we see what the examiner was requiring. So the question reads, Dakika Limited has prepared its consolidated financial statements for the year which ended 30th September 2019, extract of which are shown below. Also provided below are extract of the consolidated financial statement for the year to 30th September 2018. So we are given some information for 2 years, the year which ended 30th September 2018 and 2019. So number one, we have profit before interest and tax. We have the finance cost. We have the tax charge. We have the ordinary dividends paid, preference dividends paid, and profit attributable to non-controlling interest. And then you're told you have also obtained the following information in respect of company's share capital. Number one, you're told the ordinary shares as that is ordinary share capital as at 1st of October 2017 was shillings 15 million, made up of shares of shillings 5 per value. Number two, you're told Dakika Limited issued some 500,000 shares at full market price on 1st of January 2018. And number three, we are told Dakika Limited also made a right issue of 2 new ordinary shares for every 10 ordinary shares held as at 1st April 2019. The right issue price per share was shillings 42.5. Market value per share as at the same date was shillings 48. Number four, we are told Dakika Limited also had 1 million 6% shillings 10 per value non-redeemable shares as at 1st of October 2018. So from that particular information, what the examiner was requiring, number one, is we compute the basic earnings per share, BEPS, for the year which ended 30th September 2018. And number two, we compute the the basic earnings per share for the year which ended 30th of September 2019. So here we are required to compute the BEPS, basic earnings per share, for 2 years. And what we said is that in computing the basic earnings per share, we take the profit attributable to ordinary shareholders, we divide that with the weighted average number of ordinary shares. In other terms, we take the PATOS, divided that with what? With the one-offs. So that is the first thing we need to have here. That is a formula for computing the BEPS for the first year which ended 30th of September 2018. So the formula here is that we take the PATOS, which in full is the profit attributable to ordinary shareholders. We divide that with one-offs, weighted average number of ordinary shares. So we need to compute these two items. We start by determining the profit attributable to ordinary shareholders. And we start with that for the first year which ended 30th of September 2018. So in terms of how we compute this, we said we take the profit for the year, or the profit after tax, less the preference dividends for that year, and then we less any profit attributable to non-controlling interest. So what you're given in that particular question, we don't have the profit after tax, but we have the profit before interest and tax. So what we need to do for us to get the profit after tax, we take that profit before interest and tax, we less interest, and also we less now the tax, so that we get now the profit after tax. So to get the profit after tax. So we are going to take the profit before interest and tax, and we are starting with the year 2018, which is given as 7012. So to this we less the interest, which in other terms we refer to as the finance cost, and then we less tax, which is 1264, and that now will give us the profit after interest and what? After interest and tax. And then to this we also less the preference dividends. Preference dividend. You also have to recall what we said in our previous session, that if the preference shares issued by the company are redeemable, we don't less their dividends here because they have already been deducted in arriving at this particular profit as part of the finance cost. But in the additional information number 4, we are told that preference shares issued by this company, they are non-redeemable. They are non-what? Redeemable. So therefore, you're going to less those particular dividends here, and you are given the dividend 60,000, and then to this we also less the profit attributable to non-controlling interest. We have that particular figure as a figure of what? 160. So whatever you're going to get here is what we refer to as the PATOS, the profit attributable to ordinary shareholders. So let's compute that, but we need to first of all determine the profit after tax, which is 7012 minus 60 minus 160. Okay, sorry. We take 7012 minus 987 minus 1264. So that will give us a figure of 4761, and then we less these two items. We less 60 and also we less 160. So we get 541. So 4541, this is what? The profits attributable to ordinary shareholders. So in our case, we already have that. So next, what we need to do is to determine the weighted average number of ordinary shares. And for us to compute this, that is the weighted average number of ordinary shares, we said we take the ordinary shares issued and fully paid at the start of the year. And this particular year, which was ending 30th September 2018, this year started on 1st of October 2018. That is when the year started, not 2018 here, but 2017. And that year ended 30th of September 2018. So therefore, to compute the one-off weighted average number of ordinary shares, we take the shares issued at the start of the year, and then we add the other shares which were issued during that particular year. In our previous session, we also discussed on how we treat the various types of shares which are issued during a certain financial year or in a certain financial year. So you have to recall what we discussed in our previous session. So what you are given, if you go to the note number 1, you're told the ordinary share capital of this company is at 1st of October 2017 here is 15 million, made up of shares of 5 shillings per value. So basically what you're given here is the share capital of the company, which was 15 million. So therefore, to compute the one-offs, we take the shares issued and fully paid at the start of the year, which we are saying started on 1st of October 2017. So, and the shares issued and fully paid at the start of the year, we can refer to that as balance brought down. So what we do, we work with our figure still in thousands of shillings. So for us to be able to determine the shares issued and fully paid at the start of the year, we take the share capital, and we have to be very keen that 15 million, these are not the number of shares, because our interest here are the shares issued and fully paid at the start of the year, but this is the total value of the shares. So therefore, for us to get the shares issued and fully paid, we take 15,000 divided that with 5, which is the par value per share, and basically this should give us 3,000. So those are the shares issued and fully paid at the start. Then what we have to do is we check during this year, were there some shares which were issued? So let's check the information which are given in note number 2. You're told Dakika Limited issued 500,000 shares at full market price on 1st of January 2018. 1st January 2018. 2018. So you can see 1st January 2018 is within the first year, because here we are given information about 2 years. So you have to check whether that transaction occurred in the first year or in the second year. So therefore this one occurred during the first year. That is the 1st January 2018. So we say there was issue of shares, or basically ordinary shares, at full market price. Issue at full market price. Now, these particular shares which are issued at full market price, we said in terms of how we treat them, for the purpose of computing the basic earnings per share, we weigh them on time basis. We multiply them with the proportion of time they were held during that year. So these shares were held from January of 2018, actually 1st January, to the end of or to 30th September. So here automatically we have 9 months, because from January to the end of September, 9 months. So therefore what we need to do is to multiply these particular shares on time on time basis, or basically based on the proportion of time they were held during that year. So we have 500,000 times 9 divided by 12. That will give us 375. So and then from there we have the other transaction, note number 3. We are told Dakika Limited also made a right issue of 2 new ordinary shares for every 10 ordinary shares as at 1st April 2019. 1st April 2019, is it within the first year here? No, that is not within the first year, because we also have to recall we are given information for second year, which ended on 30th September 2019. That is September 2019. So therefore that transaction regarding the right issue is a transaction for the second year. So we are going to consider that in computing the BEPS for year 2. And then note number 3 is about the preference shares. Do we consider the preference shares here in computing the basic earnings per share? No. So therefore in our case we can negate now the one-offs. The one-offs by adding these two, which will give us 33.75. So in our case, it basically means now we have the 2 items which we require. We have the PATOS, and then we have what? The one-offs. So having that, we can then proceed and we compute the basic earnings per share, which will be equal to PATOS 45.41 divided that with one-offs 33.75, and that now will give us the earnings per share, the basic earnings per share. So the basic earnings per share will be 45.41 divided by 33.75, and this will give us shillings 1.345, which is shillings per share. So basically that is it, that what is required as far as the Roman 1 is concerned. And you can see the marks which were located there are 4 marks. Mostly what will be marked here is the PATOS. Were you able to get that figure correctly? And also this, were you able to determine the shares issued and fully paid at the start? And also were you able to treat or basically to deal with those particular shares issued at full market price? Basically by doing that, you get your 4 marks. So let's move to Roman 2 of that particular question there, whereby we are required to compute the basic earnings per share for year 2, which ended 30th of September 2019. So Roman 2, BEPS, basic earnings per share, for the year which ended 30th of September 2019. So the formula for computing this remains the same. We take the PATOS all of our notes. We don't need to repeat the formula because the formula is not marked. So, but what we need to do is to determine these 2 items, the PATOS and one-offs. So let's start by determining the PATOS for the second year. So the procedure is the same. Take the profit after tax minus preference dividends minus the profit attributable to ordinary shareholders. So the profit after tax, equally this one is not given, but we are going to compute it in the same way. We take the profit before interest and tax, which is given as 830, minus the finance cost or minus the interest, 1045, minus the tax charge, which is 1718, and basically that will give us the profit attributable to ordinary shareholders, not the profit attributable to ordinary shareholders, but the profit after tax. And then to this we less the preference dividends, the preference dividend, and also we less the profit attributable to non-controlling interest. So the preference dividends still is a figure of 60 as the first year. The profit attributable to non-controlling interest is 180. So this will give us now the PATOS. So let's first of all we work out the profit after tax, which will be 8830 minus 1045 minus 1718, so which will give us 67, and then to that we less 60 preference dividends and profit attributable to NCI, which will give us 5827. So in our case we already have now the PATOS. Next we need to proceed and we determine the WANOS, weighted average number of ordinary shares. So we know that the second year here started on 1st of October 2018. That is when the year started, 1st of October 2018. So what we need to do is to determine the shares issued and fully paid at the start of the second year. So this is something which the examiner will not have given you. Anytime you're given information about 2 years, is upon you to determine the shares issued and fully paid at the start of the second year. Where do you get that information? That information is not in the question. You get it from the computation you did in the previous year. So from the previous year, we know the shares which were issued and fully paid at the start were 3,000. So you take those shares, 3,000, and then you check during that year, were there other shares which were issued? Yes. So we have these shares, 375. But now what you do, you take the actual shares. The actual shares were not 375, but the actual shares were 35, because those shares as at the start of the second year will be issued and fully paid. So therefore, you take the actual shares and basically you add them to the shares issued and fully paid at the start, which will give us 35. And then you check during the second year here, was there other shares which were issued? Yes. So in note number 3, we are told on 1st of April 2019, there was a right issue. Remember, you said in our previous session that this is a very, very common concept, a very, very important concept which is tested in almost all questions for earnings per share. So, and what we said is that during a right issue, the company issues additional shares to the existing shareholders of the company at a price which is below the market price. As a result of that, we said those shares which are issued to the existing shareholders of the company, some of them are deemed to be issued free of charge, whereas others are deemed to be issued at full market price. And therefore, we said these shares issued during the right issue, we have to split them into two components, into shares issued at full market price and the shares issued free of charge. But for us to do that, we need to compute two items. Number one, we need to determine how many shares were issued by the company during the right issue. And number two, we also compute something known as theoretical ex-right price, which we said is the expected market price per share after the right issue. I gave you the formula for computing the same. So therefore, what we need to do as far as this right issue is concerned, we need to compute two items. Number one, the shares which were issued by the company during the right issue, because we are not given that. How many shares were issued during the right issue? So as per the information we have in note number 4, we are told during the right issue, the company was to issue 2 new shares. The company was to issue 2 shares for every 10 shares which were held. For every 10 shares which were held. So what we need to do is to ask ourselves, before this particular right issue was made, how many shares were held? And equally, you can't get that in the question, you can only get that from your computation. So before this right issue was made, you can see the shares which were held or which had been issued by the company were 3,500. So those are the shares which were held. So we need to determine how many shares were issued during the right issue. We cross multiply, then we divide. 2 times 3,500 divided that with 10. So this will give us 700 shares. So these are the shares issued by the company during the right issue. Those are the shares we are going to split into two components. Shares issued at full market price, shares issued free of charge. But before we do that, we need to compute something known as theoretical ex-right price. This is something which the examiner will not have given you. You have to compute that. So there is a formula which we use and which you covered in FM, Financial Management Intermediate level. But I gave a very simple approach of computing this in the previous session, because if you go back to the information which we have, there is some information or some details I want us we get there from note number 3. We are told in the last sentence of note number 3, the right price per share was 42.5. So mean that because during the right issue, the company was to issue 2 shares for every 10 shares which were held before, these 2 shares which were to be issued by the company during the right issue, each share was to be issued at 42.5. But now, the shares which were held, or basically the market price per share before the right issue was 48. So that information, we need to have it here. So and therefore, once you have that information, we said you come here and you say, before the right issue, if you held 10 shares, and each share was trading at 48, that's what we know, then during the right issue, as a shareholder of this company, you are to be issued with 2 shares. Record the shares there, 2 shares at a price of 42.5. At a price of 42.5. So basically what that means is that after the right issue, as a shareholder of this company, you'll be holding 12 shares. If you held 10 before, after you'll be holding 12 shares. And what will be the total market price of these 12 shares? To get the total market price of those 12 shares, we need to multiply this and this, which will give us 480, and then 2 times 42.5, which will give us 85. So and then we add the 285 plus 480, which will give us 565. So basically what that means is that after the right issue, a shareholder will be holding 12 shares, and the total market price of those 12 shares is 565. So what is our interest? Is the market price of 1 share after the right issue. So which is equal to the price of 12 shares, and then we divide that with the 12, so that we get the market price of 1 share after the right issue. So that will give us 47.08. So this is basically the theoretical ex-right price, the market price per share after the right issue. And I think having that now, what we need to do is we proceed and we split these shares into 2. The shares which were issued during the right issue, we split them into 2 components. Number 1, we determine the shares issued at full market price. And we said in terms of how we compute this, we compute, first of all, we determine the amount received by the company from the right issue, which will be equal to the shares issued during the right issue, 700, times the amount which was to be paid per share during the right issue. The shareholders were to pay 42.5. Then divide that with theoretical ex-right price, which you have computed down there, 47.0833, that is 0.83. And because these particular shares are issued at full market price, the rule is that they should be weighted on time basis. They should be multiplied with the proportion of time they were held. So these shares were held from April to September. So how many months do we have there? Those should be 6. So we have April, May, June, July, August, and September. So we have 6 months out of 12. Make sure your computation there is correct. And then finally, we compute the bonus shares. Bonus shares, these are shares issued free of charge. we looked on the formula and we said we take the total number of shares which were issued during the right issue, 700, minus the shares issued at full market price. The shares issued at full market price is what we have here. Not the final answer you get here, but what you have here. In fact, just transfer this here. These are the shares issued at full market price, 700 times 42.5 divided by 47.083. And equally, we said that these particular shares, we don't weigh them on time basis. We don't weigh them on time what? Basis, because they are shares issued free of charge. Yes, so let's first of all determine the shares issued at full market price, 700 times 42.5 divided by 47.03083, which will give us 631. 631. Okay, let's take that again. So we have 700 times 42.5 divided by 47.083, okay, times, or basically divide that with 2. So that will give us 315.9. 315.9. Can we take it to as 316? Yes, let's take it as 316, and then we compute the bonus element here. So we have 700 times 42.5 divided by 47.083. Okay, and then we deduct that from 700, which will give us 68, around 68 to the nearest whole number. Remember, these shares are not weighted on time what? Basis. Yes. And I think now with that, we can be able to get the one-offs, the weighted average number of ordinary shares, by adding all what we have there, 35 plus 316 plus 68, which will give us 3884. 3884. Basically, what that means now, we have the one-offs, we have what? The patos. Having that, finally, let's compute now the BEPS, the basic earnings per share, which will be equal to the patos, profit attributable to ordinary shareholders. We divide that with the one-offs, which we have here, 3884. So this will give us what? This will give us an amount of what? That is 5827 divided by answer, which will give us 1.50, 1.5 what? 0. So that is it. Basically, that's what was required as far as that question says is concerned. And how many marks were allocated in that particular question there? 6 marks. So definitely 1 mark, or basically this was one of the items to be marked there, the profit attributable to ordinary shareholders, determining the number of ordinary shares issued and fully paid at the start of the year, and also computing the number of shares issued during the right issue, splitting them into 2 components, into shares issued at full market price, the bonus element, and also this particular price here, the theoretical ex-right price, mostly that is allocated a mark, because most of the students have a challenge in terms of how to compute what? That. And basically by doing that, a candidate secured how many marks? 6 marks. So therefore that is it, that what the examiner was requiring as far as that question for November 2019, question number 5A is concerned. And that is all about the computation of the basic earnings per share. So once we come back in our next session, I want us to discuss on the second type of earnings per share, the diluted earnings per share. We look on how it is computed, why companies are required to compute the diluted earnings per share. And then from there, we look on an illustration question, which is also based on a past paper question. So see you in the next session.